In today's video, I want to run through some of the data to examine whether we may enter a recession in 2025 or not. We're going to look at some of the bullish arguments and some of the bearish arguments. Now, I think this is particularly relevant today because starting in September, we just entered a rate cutting cycle. And if you look at the history of rate cutting cycles, stock market returns on average are positive 6 months, 12 months after the initial rate cut. However, there are huge market declines following rate cuts whenever a recession follows. So whether this rate cutting cycle kind of ends in disappointment is really probably going to hinge on whether we enter a recession in the near to intermediate future. Now, my name is Scott Caulfield. I'm a CPA and CFA charter holder and the founder of Sophos Wealth Management. You know, I kind of like the quote that Mark Twain popularized. There's three types of lies: lies, damned lies, and statistics. And I think in this environment, you can kind of argue either side with statistics and some of the data. If we start with the bullish data, you can look at real wages. They are all of a sudden growing again. Real wage growth currently about 1.5% in September. Last couple of years, it's been strong. It's been increasing. Strong real growth is going to really help the overall economy, as especially if this flows to lower and middle income. That often has high turnover and helps the economy out. So, you know, after that high inflation period of 21, 22, it's nice to see this get back to growth. The next bullish area would be the ISM Services Index. So this is the ISM Services PMI. Looks at the services sector of the economy and figures out, are we in expansion or contractionary territory? Anything over 50 means it's expanding. Anything under 50 means it's contracting. This has been in solid expansion territory for a while. We recently had a couple contractionary prints that had some people worried, but most recent print back up at 55, still looking solid. And then probably most importantly, if we look at current GDP growth. So the Atlanta Fed has a great estimate. It's called the GDP Now. It most recently is estimating Q3 GDP growth of 3.2%. That's ticked up from the low twos. 3.2%, that sounds pretty great. So, you know, if you look at all these kind of concurrent indicators of economic growth, it looks like we're in solid expansion territory at the moment. Caveat here is that just because we're currently growing, it doesn't really tell us what's around the corner. In fact, if you look at the final quarter of growth before recessions historically, you've typically seen on average positive growth, real GDP growth around 0.77%. It's been as high as nearly 5% back in 1981. And then more recently, if you look at Q4 2007, GDP growth was still 2.54%. So that was Q4 2007, right before things fell out of bed in 2008. Now, the other indicator that I didn't really necessarily mention yet is the stock market. The stock market kind of famously has predicted 10 out of the last 5 recessions. Typically goes down on recessions or recession scares. The fact that it is currently making new highs or close to new all-time highs would indicate that recession's not around the corner. Now, the flip side is what are we seeing that says the economy may be going into recession? These are typically recession indicators that would point to the future. Now, one of the first ones that people are maybe arguing is broken would be like the ISM Manufacturing Index. So this has been in negative territory for 22 out of the last 23 months. Anytime this has gone this negative in the past, we would have been in a recession a long time ago. Now, manufacturing is now a much smaller component of the US economy than it used to be. And, you know, it looks like this may be a broken indicator because clearly GDP growth, as we just saw, is still positive. We should have been negative a while ago if this was still kind of a relevant indicator today. Now, I do think this is a good example, right? We talked about lies and statistics. If somebody wanted to point this out, they could say everything is horrible. And for manufacturing, it is. But because that's such a small component of the US economy relative to services, it's not really been a big deal this cycle. More concerning are things like yield curve inversion. So in the US, every time we've had a yield curve inversion, that's where short-term rates are yielding more than long-term rates. Every time we've had that, we have typically had a recession on average 14 months after the yield curve inversion starts. The thing is, the caveat to this one is this has been the longest yield curve inversion in US history. The last two longest ones ended in 1929 and 1980. Now, those were two really bad recessions. Bulls would just say, hey, yield curve inversion is no longer relevant, especially with the zero bound on rates this kind of cycle. Bears would say it just hasn't happened yet, and this one might be nasty. So, I think the jury's still out on this one, but historically, having a yield curve that inverts, and then when you see it uninvert, which it has here recently, that is typically when we're either in or right before the recession. So something to keep an eye on there. And finally, and maybe arguably most concerning, would be unemployment. So the absolute level of unemployment at the moment is still quite low, but it has ticked up off its lowest level. Historically, anytime unemployment has ticked up 0.5% from the 3-month moving average, you have been in a recession. It's called the Sahm rule. And we triggered the Sahm rule back in July when unemployment got up over 4.3%. That's one of the things I think the Fed was relying on to cut interest rates by 50 basis points rather than 25 basis points. However, Claudia Sahm, the creator of the Sahm rule herself, has kind of given reason to be skeptical about the Sahm rule in this cycle, particularly just the post-COVID unique features of this economy. And I think she would point out that the massive number of immigrants we have in this country is increasing our unemployment rate. And that's kind of throwing things off versus the past. So it may not be the indicator or may not be as reliable as it was in the past. And backing up that skepticism, the most recent unemployment rate came out and it dropped from 4.3 down to 4.1%. In fact, the unemployment report was so strong that a lot of bears were questioning if this was somehow doctored. I think Marco Rubio came out and was almost accusing them of trying to support Democrats in the election by gaming this, which, side note, the odds that a government agency such as the BEA could send out a doctored report without somehow having a leak or getting caught, I think is close to zero. On the one hand, you have people who think the government's incompetent. On the other hand, you have people who think somehow they're going to pull off this great conspiracy. Not really congruent in my book. Even with the strong report, we have seen this uptick in unemployment. It's possible the strong report could be revised and the unemployment rate could continue ticking up higher. And if you just think about this historically, and the reason the Sahm rule has worked is it's somewhat self-reinforcing. As unemployment starts to tick up, you have more people concerned about their jobs, more people reining back their spending. Those who lost their jobs are obviously cutting back even more. In turn, this leads to sort of a softening of the economy, it leads to more layoffs, and it's a self-reinforcing cycle. And as you can kind of see from the history of this chart, once it gets going, it tends to spike up quickly. Hence, we're already in recession. The takeaway here is we've got strong current GDP growth, but that doesn't really tell us anything about the future. We have recession indicators that are all flashing red warnings, but they may be broken in this cycle. So uncertainty persists. I tend to focus more on what are clients' goals, my concerns about overall equity market valuations in the US, things like that. So anyways, I always encourage you to like this video, subscribe to my channel, and check out my website if you want any more information. Thanks for tuning in.